Good evening and welcome to the FITT Show. Financial information for today and tomorrow. I'm Bobby Kinzer.
I'm Thomas Doty.
And we are the FITT Show, helping our people get their finances in shape. How are you doing today, Dope?
I'm doing great. Hanging
That
out
is great. That is great. You say you where?
Myrtle Beach.
Man, you get around. Boy, like I'm telling you, you're like a metro. You get around. But last week we had a great show, ladies and gentlemen. We talked about our exchange traded funds, ETFs better than mutual funds, and we hope we answered that question for you. Um, it was a very enlightening show, and hope you picked up some information on that. This week we wanted to be talking about how too much cash can hurt you. But before we get into that, just want to give a few administrative duties that I want you to make sure you take care of. Please click on the like button and the heart button that gives us traction, like we always speak about. And please put any comments in the comment box, but not just comments for the sake of comments. I mean, that's cool too. But if you have some opinions on what we talked about, because we know sometimes you may not always agree, or you might have an even better opinion than what we're talking about. And if there's a subject that you like to talk about, a question you have, this is our way to interact with our audience. So use that comment box. Please definitely go out there and do that. With that, though, I'm going to say, take a deep breath because, ladies and gentlemen, we're going to talk about the stock market today.
Yeah, I was hoping you would forget that and we would just skip right over it.
And
Ugly.
why would you say that, Thomas Doty?
There's a couple of things going on. The Dow's had 3 straight days of losses. It, actually the S&P 500 had its worst day since March. I mean, it's
Wow.
been bad. Working on a real bad week as we speak. And the driver behind that is the fact that there was only a small drop in jobless claims. It's really 3 reasons. The small drop in jobless claims. Number 2 is the fact that investors aren't certain that they're going to be able to keep the government running. It looks like it's likely that there's going to be a government shutdown, and that's going to mess up for GDP, which also has a negative effect on the stock market. Because the things aren't slowing down as quick as the Fed would like, he's kind of indicated that even though they didn't raise interest rates this week, that there may be future interest rate rises coming, or interest rates may stay high for a while. And so all those things are having a very negative effect on the market. Treasury yields are going up, which means that at high interest rates, you get to the point where, hey, if you can get 5% in bonds, maybe you don't want to take the risk in the stock market right now. And so it's been a rough week. Hopefully things will get a little bit better. The last week, the Dow's dropped 800 points, NASDAQ's down 700, and some of my stalwart stocks have taken a pretty big hit. Microsoft's down 19, as is Tesla. Apple's only down a couple of points, but if you remember, Apple had been up around its all-time high, but it's fallen off from that. That was up in the 190s. It's down to 174, down 2 points since last week. Pfizer only dropped above, and NVIDIA dropped 40 bucks. So things are a little bit tough right now. And I always say when things drop like this, it's buying opportunity time. So, but we'll see how things go. Hopefully they reach some kind of agreement to keep the government from shutting down, and that'll take some of the negativism out of what's going on right now. But all in all, it's been a pretty tough week, and hopefully things will improve.
You know what I find interesting, though, is when you look at these Dow and Nasdaq numbers, coming off of the Obama and Trump presidencies, the Nasdaq was at that time at about 16,000, and
Hmm.
the Dow was maybe at about 36. So we're not that far off from what that market was. Was it 2 years ago, 3 years ago now? It's
Right.
3 years ago actually. So it's kind of interesting, even though, and that's why we always talk about it's the long play, because you look at these numbers, you just look at the day, you go, oh my God. But if you've been playing the market in the last 5 years, you still up. You should,
Exactly.
you still should, you know.
Yeah, and we always talk about not overreacting to big swings, either up or down. The key is, as you say, it's for the long play, and you just need to be patient. And usually, or history has told us that the Dow is going to continue to, the stock market, the S&P 500, is going to give you about 9% on average every year. So just kind of hang tough and keep your head down and don't worry about the big ups and downs.
And guess what? That 9% is doing better than the Social Security, which gives you 8% every year. So you're 1% up. So dope. Just wanted to talk about portfolio balance, how things are going right now, and gold is up about $1.50 per ounce.
Hmm.
So once again, if you play it right when things are down, if you have another sector in your portfolio that can gain when things are down, and that's another sign of a balanced portfolio, having some commodities. Just wanted to share that with you because my gold is up. It's heading to 2000 again. So, Doe, let's talk about my favorite subject, cryptocurrency. Oh my God, it's just giving people so much heartburn, man. The total market is down about 5 billion, which is not a lot, believe it or not. And the Bitcoin is only down $41, which is not a lot from last week, that is, at $26,588 per Bitcoin. So if you got in around about 2014, even 15, you still ahead, matter of fact. But if you got in around about 2021, you might be underwater with the Bitcoin and other cryptocurrencies. Um, Shiba Inu is dropped all the way down to 17 now, though it was at 16. And that was a lot of people was into the Shiba Inu, which is called a meme coin, like a picture, a baseball card. That's what that was. And it was rolling. I'm talking about, I know people that made hundreds, thousands on that, but Shiba is just tanking. Who knows if it'll come back? But like we say, if you're investing into the cryptocurrency market, make sure you're investing money that you can be willing to lose. And that's kind of sounds like an oxymoron that anybody wants to be willing to lose. But I hope you understand the strategy behind that. So, dope. Let's talk about this, man, for a minute, man. You know, cash. I mean, let's talk about cash though, because that's an important asset, should I say?
Right. And a lot of people feel safe holding cash, but holding more cash than you need, not the best thing to do, and it can be put to better use. And a lot of people do it because they feel safe, they feel comfortable, they can know it's tangible. I've got my dollars, I've got my money. People put it under their blanket, they put it in savings accounts, they put it in checking account, and they don't really worry about how much money they're making on that. And for the last, 6, 7, 8 years, that hasn't been a problem because the interest rates that you could get on that cash has been nothing. And so you got to get, it's different now because interest rates have gone up. That's all we've talked about last couple of months is how much inflation is hitting us, how much interest rates are going up. And the big thing is if you aren't getting the most, you lose purchasing power. Your dollars that you're holding won't buy as much now as 1 year ago. So if you're not maximizing your money, you're going to be in a tough spot. So you've got to make your money work for you. And there's a lot of reasons people don't do that. And some of it is because they don't know. Some of it is because they're comfortable. And some of it is because they haven't realized that there are other first about some of the reasons people hold on to too much cash.
Now, Americans are saving more of their income than ever before. As a frame of reference, the personal savings rate has been hovering around below 10% for the last several years. But after the pandemic, and they did a survey, and in 2021, the personal savings rate skyrocketed from 10% to 33%. Now, the impulse to hang on to as much cash as possible is an understandable one, especially in times like these. Now, cash offers a sense of security, and it can be filled with reassuring to accumulate more of it in challenging situations, as a buffer against unexpected events. That said, it is possible to have too much cash. Now, that probably to some people don't make sense, but you should always have enough cash on hand to cover your expenses and potential emergencies. Beyond that, your high yield cash account should not be your only savings vehicle. Now, the annual percentage yield for high interest cash and savings accounts seldom keep up with the rate of inflation. We talk about that all the time. Inflation is at the purchasing power of your money, meaning that if you're sitting on a pile of cash, it's probably losing value. Now, this defeats the purpose of saving. When you hoard cash, you do yourself and your financial goals a disservice. Instead, you're better off investing in a globally diverse portfolio or even like a low index fund where your money can actually grow and get you closer to whatever you're savings for. Now, if there's a bunch of cash you're sitting on in a checking account, you might be holding too much cash because any low or zero interest bank account could ultimately be viewed as a temporary holding tank for your money. Why? Because if it's sitting in a low interest bearing or zero savings account, your money isn't working for you in these accounts. Guess what? It's just sitting there working for the bank. So, Doe, let's talk about the first thing that we should think about when we talk about too much cash.
Well, and the reasons people who do it, one of the main reasons is loss aversion. We're more motivated to avoid loss than we are to pursue a gain. And that's something that's haunted. Mostly folks who don't have money. And when they get money, it means a lot more. And they are very, very worried about losing it. And the pain of losing $10 is only matched pleasure of winning $20. That's the effect of people not wanting to lose money. And we express that loss aversion when we say things like, I don't want to risk all my money, or I'm worried the market is peaking and it'll be wiped out. We keep our cash out of investments because we're afraid of losing it. But when we sit on too much cash, we really stand to lose something else, and that's purchasing power, which can be critical.
Yeah, very, very critical. But there's another one, though, that we sort of suffer from, which is called present bias. And what do we do when we feel seasick? We shift our gaze from the waves shaking the hull out to the calm stability of the distant horizon. The same principle applies when we're navigating through rough financial waters. Now, present bias is just the principle that explains why, for many of us, now matters more than later. Now is about the present. The emotions of the present greatly outweigh the potential benefits of the future. Now, in fact, we consider our future selves to be completely different people. While doing something right now feels good, doing something for our future elicits close to no emotional response. That's why it's so hard to do things today, whether it's exercise, eating healthy, or letting go of our cash that will benefit our tomorrow. We connect to our cash now more than our investment outcomes later. It just feels better, though. So, what can we do? Instead of thinking about the next 6 months or year, we can think about the next 6 years or decade. Remember, we're not investing for ourselves today, but for our future selves and our families many years from now. Now, research has shown that when we make that future more personal and visible and detailed, we can see it more clearly and it feels more viscerally. It helps to be specific. We're not just retiring in about 20 or 30, 20, 30 years, but we're retiring on February the 6th, 2043. That's 20 years. That's a specific date. And doesn't that just kind of visualize a little bit different? The details of visualizing a trip or second homes or special events. What's the weather like? Where are we? And with whom? Let's look at our elders and imagine how we might appear 20, 30 years ago. Ooh, that could be scary. What we do sound like? What do we feel like? How happy are we when we achieve our goals? We need to think about that and look to the future so that can drive us to thinking about doing the things that can help us meet those goals in the future. Now, we also might overcome present bias by taking a solace knowing that historically sticking with a long-term investment vision has provided less volatile and more stable returns. It's just a fact.
Holding cash, you can be sure that your purchasing power is going to erode. The balance in your account may stay the same, but what you can buy with that money is going to shrink. If you look at the value of the dollar today and compare it to what it's expected to be in 2026, by 2026, it's projected that $104 will have the same purchasing power as $100 in 2023. In other words, if you aren't growing your money, what you can buy is going to decrease every year. And so if you develop a plan for a personal goal, whether it be paying for college, paying for a wedding, or taking a grand trip, those goals are real. They're real numbers. And if you don't achieve those goals, you're going to be missing something, whether if it's a wedding, maybe it's a flower arrangement. If it's a trip, maybe it's an extra week's vacation. But all those things will add up with losses unless you maximize what you're getting out of your savings. And of course, we're not saying you don't keep any cash. That would not make any sense because you're going to have emergency and you do need cash on hand just in case something do happen. But you don't need to have too much cash. That's the worry. And for many of us, having a huge nest egg or a huge hunk of cash makes us feel safer. That perceived risk that we might be investing cash kind of scares some people, and so they don't want to be fully invested. But you got to remind yourself, if history is any guide, even if we do invest at our peak of the market, we are still likely to prosper in the long term.
We tend to have this need for control, which drives us sometimes to have so much cash. Like keeping a lot of cash allows me the flexibility to change my mind and be opportunistic. We all said something like that. When we talk about flexibility or being opportunistic, we're really talking about our desire for control. The need for control is a basic motivator of human behavior. And because cash is the most tangible, fungible, accessible, and emotionally connected form of money, holding on to it offers us the feeling of control. But when we fail to maximize our financial resources, we're actually giving up the control. We're sitting back waiting for some unforeseen event or person to dictate our options. Now, using our money wisely is the best way to control our future. It's the best way to take control of our future. That's why we build financial plans and wealth strategies in the first place. Harnessing the potential of our cash is a smart way to support these plans and strategies. Now, it makes our money work for us in a framework that takes into account our risks, opportunities, our needs, and even our desires. There are even strategies that provide the immediate flexibility of cash if that's part of your plan.
And everybody's heard cash is king, cash is safe. You know, and people think, oh, and if markets volatile, if there's political unrest, if there's social unrest, I'd rather have cash because it's safe. And cash does feel safe because the number stays the same. But that number doesn't represent what you can buy. Your purchasing power is shrinking. And what you can do with that money. And that makes a difference in what you can buy. And we say cash can protect us over the downside more than some investments, but government bonds and certain municipal bonds, they've retained more value than, and they also offer an opportunity for some growth. And so, oh no, there's no guarantees in investing, but history reminds us how good even the bad times can be in the long run when we look at the stock market. And we've talked about this before, how if you look at the stock market, after each of the worst case scenarios, the worst thing that's happened, the COVID, in anything you name, the market has always recovered.
So, don't with that. I like to show a chart 'cause we like to do visuals so people can see what we're talking about. Let's look at a particular chart here, Doug. Now, this particular chart is it says its investment portfolios are built to last, even in sudden changes. So let's just take the Y2K, right? 1999. Everybody thought the sky was falling. It was going to be the end, and you're going to go to the ATM, and wasn't no money going to come out. Now that was a big drop, but look, the total return after that event was 293%. Then, look, let's go down to 2002 when the dot-com bubble happened. There was a markdown of 49%. I remember that, though, because that hit my 401k plan hard. But I stayed, and it bounced back. The total return came back 264%. We can go down even down into when the Brexit vote happened in the U.S. election in 2016. The market took, a hit, but it returned 67%. Then you talk about the COVID 2020, which was a major hit, and then you had the U.S. election at that, the pandemic took a big hit to market. But look, it came back and gave a total return, a cumulative total return of 12%. Now, if you look at this line, squiggly line, like a gray line that's going up, that's actually showing you what if you were in a portfolio where it was 60-40, 60% stocks and 40% bonds, and you look at that graph, that line, the linear line, it just went up, and up, and came down, and it still was up because it was a balanced portfolio and because it reaped the returns of the market. So just wanted to share that with you all, because that was a telltale sign, though, of when times happen, certain events happen, but still the market tends to return, and you got to be patient. I'm not going to lie. Some people it's just not for, and some people is. But the big picture for your wealth strategy should be, like no one ever laid on their deathbed wishing they spent more time with their money. We don't necessarily want money. We want what money can provide: security, autonomy, control, power, respect, freedom, a sense of pride and achievement. Now, these personal goals can be hard to quantify and articulate since money is easy to quantify if but it often becomes a substitute for what we really want. What is the purpose of your wealth? It's a very interesting question that you should ask yourself. What do you want your money to do for you? It can be hard to think about, but that's a key reason we develop our goals based on a framework, understanding that liquidity and cash are just one part of our financial plan, one bucket in our wealth strategy. But, holding excessively large cash deposits is an understandable choice, but maybe an irrational one. When we comprehend why we make that choice, we might be able to reframe our decision making process to keep us moving along our own personal journey to a richer and more meaningful life.
So let's talk for a minute about what other things we can do with our cash. And many people turn their nose up at looking at the best savings account as we've gotten used to getting no returns, or people just don't take the time to pay attention to those returns. Well, millions of people across the globe leave their emergency funds or spare money in the current accounts paying little or no interest, or in old savings accounts that pay nothing. And we always want to look and say, let's find a way to maximize our money, make the most that we can, always looking for the best rate. And it can make a huge difference, you know. And while I can't tell you whether to save or invest, that's a personal choice, based on a number of factors that are personal to you. What I can say that if you are an investor, then I would certainly be considered guaranteed returns of about 5%. And you can find that in a CD, you can find that in high yield savings account, or some of the better money market funds that are out there now. And with so many saving options out there, choosing where to store your cash, it can be challenging. But both money market accounts, high yield savings accounts can help you build your savings. But deciding between the two can be a little bit tricky. And that's because they don't have many drastic differences. They're pretty similar, but they are very different. And so there aren't extreme differences between a money market account and a high yield savings account. Both have their pros and cons. So when you choose a money market account, so why would you choose a money market account over a high yield savings account? And that's what most people should be choosing right now. Those should be the two things you're looking at. And money market accounts usually are better suited for people who have larger amounts of money. They're looking to be able to meet a minimum balance requirement, because typically you have to have a certain amount of money to open that account, and you're trying to avoid fees. On the other hand, individuals who are just beginning to save and don't have large amounts of money probably should opt for a high yield savings account. Additionally, because cash is more accessible in a money market account, it's a good choice for individuals who plan on spending from that account fairly often. Now, you may ask, where can you find out who has the best rates? What kind of accounts are available? There's a website called bankrate.com, and you go there and it will list you which institutions are paying the highest rates. It'll show you what the requirements to open an account, minimum requirements. It'll show you the fees. It'll tell you everything you need to know to make an informed decision about where you should be keeping your money. It'll show you CD rates, so you can make a choice between a CD, a money market, and high yield savings account. But again, you got to know what you're doing. If you need to get financial advisors help to help you figure that out, do that. But it's really not that difficult to do if you're talking about just your idle cash. You go out there, figure out which one's paying you the best interest rate, understand what the ramifications or the restrictions or qualifications are, and go get that higher interest rate.
Yeah, dope. So that brings to the question is, can you make thousands switching your savings account? What do y'all think? Well, check it out. At 5% returns for every $1,000 you have, you're earning about $50 per year, which is not to be sniffed at or throw your nose at when you look at, the recent averages. Now, just think if you had $100,000, that's another $5,000 per year, which could pay for vacation or upgrade to your home. Now, I recently have moved savings around to take advantage of the higher rates out there. Now, I would encourage others to do the same, as otherwise you are throwing money away. Now, switching can take as little as a few minutes, and if that can earn you hundreds or even thousands more per year, I say that's a good few minutes well spent. Now, I would have thought this a year ago with, so much gusto and so much encouragement when rates were so much lower, which reduced the incentive to switch and made savings look less attractive versus the best investment. But this is the most exciting time that I can remember for a savings market as we are coming out of these doldrums and into the light. Yes, yes, I did actually put money in savings, and I did say put money in a 5% savings account is exciting in the same sentence, because for us personal finance people, it's an exciting time when it comes to talking about being able to gain a little bit more interest in such a low risk investment when you start talking about high yield accounts or money markets.
Yeah, and one thing I didn't mention, I mentioned backing up a little bit, CDs, money market, and high rate savings account. There's also T-bills, and again, understand the ramifications. And some T-bills in I-bonds, you don't pay state taxes. That's another little thing you might want to keep aware of if you live in a high tax state. T-bills may be your best way to go. You go out there to treasurydirect.com and you can see what interest rates they're paying for T-bills, different time frames. And again, you get a little savings on your state income tax. And the thing we don't know right now is that savings rates could go even higher. I mean, there's a chance rates could improve even further because, as the Fed discussed this week, they may see the rates later. I mean, they kept things flat for right now, but I mean, rates are still as high as they've been in 22 years. So there's a possibility that rates could continue to go higher, and we'll see what's going to happen. But while rate laws doesn't guarantee the rate's going to go down, banks tend to closely follow what the Fed's doing. So we'd expect, the rate increases to be smaller than they have been. And nobody can control what the Fed does. So that you have no control over that. You have no control over what's happening in the economy, whether the government shuts down or any of that stuff. But what you do have control over is how hard your money works for you. And to not try to maximize the money you have is just not the way to do it. Get the money working as hard as it can. It may take a little effort to find out where to put your money, to close an account, to move money over. But in the long run, it'll be well worth it. Like Bob talked about $100,000 at 5%, that's $5,000. And even if you say, okay, $5,000, that's not much, but take that over 10 years, take that over 5 years. You're talking about a nice little hunk of change that you get for basically doing nothing but moving money from one account to another account. And you do have to take some time because it's not something that you do one time. You go and look at rates. You have to continuously, quarterly, every other month, check and make sure wherever you have your money is paying you market rate or the highest market rate. You can go out to that bakerate.com and see what other institutions are paying. Make sure your bank is paying you, your bank or institution, I should say, is paying the highest rate that you can get. It only makes sense to do that.
Yeah, I mean that's good advice though, but and we do know historically, and we I always talk about risk and reward. And we do know most people, especially our people, are not risk takers. So it's so easy to sit on cash. It's so easy to feel more comfortable with cash. But, if you have goals, and I know a lot of people on here are either retired or heading to retirement, and you worry about that horizon of when you retire, or you feel, well, what more do I need? I got a house, got a nice car, got money in the bank, and but if you have goals like generational wealth for your kids and your grandkids, then why not maximize that cash? Because sitting around. But let's talk about the summary and takeaways though, because once again we talked a lot today, but let's summarize it and put it there where people can really understand it. Let's bring it home.
Okay, you first.
Cool. Okay. Thank you. So become a savvy saver, meaning think about the future, like I was talking about. Think about not just 1 year, 5 years from now. Think about 10 years, because we're living longer, and we need to be smarter with our decisions, and definitely with our cash. And I know everybody wants to get the most out of their money. I bet you everybody agrees with that. But the more knowledge that you tend to get, the better you are able to make better decisions. So become a more savvy saver by, looking at your options and really, really, really thinking about how can I maximize the return on the cash that I have.
Yeah, holding cash erodes purchasing power. Example we always use, if you got something, you got $100 in a bank and it costs $100 today, you can go buy that item for $100. Inflation hits it at 8%. That thing now costs $108. You still got $100 in the bank. You're $8 short. You got to find a way to close that gap. Holding cash erodes your purchasing power. Make sure your money's working for you.
Now, we talked about this, switching savings accounts, switching between savings accounts or even money markets. Shop for competitive rates. That's a little new because most people are used to just staying in the bank that they've been in for years, because that's the bank that's convenient to them. That's the bank that's down the street. That's the bank that they got a loan for their car or a loan for their kids' education, so they feel comfortable with. But these are different days and times. These are different days and times, and because of technologies, you can switch from different accounts way more accessibly and more flexible than in the past. But same thing I've seen with people with cell phones. They stick with the same cell phone, but there's so many different cheaper cell phone carriers, but we so comfortable with what we're used to having. Same thing with shopping for competitive rates, and especially in this market now, because like Dodie said, there's a possibility that the savings accounts, especially the high yield savings accounts, might go even higher. So why not, put your money into that? We talked the other week about CDs, even though CDs lock you down for 6 months, but why not take advantage of that 6 months and then the next 6 months see what happens? So that's the concept behind shopping for competitive rates, because that's just a little bit different than in the past than what we're used to.
Yeah. And finally, idle cash doesn't build wealth. It's just pretty much the balance is going to stay the same. It's not working for you. And we've talked about this before, how people with money, rich folks, their only concern with money is how is that money going to make them more money? And that's how you should look at your money. How can it make you more money? How can you maximize what you're saving? And we've talked before, if it doesn't really, we're not even talking about risk here. We're just talking about doing a little research, finding who's paying the highest interest rates. And most of the things we're talking about, whether it's CDs or high yield savings rate, are all things that are FDIC insured. So I wouldn't recommend putting over $230,000 in any one of those types of accounts, because that's the max on the FDIC insurance is 250, and you want to make sure you stay under it, even with the interest that you gain. So I try to stick to around $235,000 in each account, but there's no risk involved. This is just a matter of you taking the time to maximize what you're getting on your idle cash. Takes a little bit of effort, but get percent instead of 0.001% is always better.
And this is the rub though, what people don't tend to realize, right? The banks are using your money, okay? And if you're not using your money, trust me, they're using your money. So if you're getting like 1-2% and they're loaning your money out at 7% for a mortgage, that's your money. So why not have your money working for you instead of for the bank? And that's why, like, we know it's not for everybody. So let's get this straight. And you all know by now that me and Dope are definitely pro stock market as far as building wealth. But we also know, and just think about within that subject, I'm more conservative and Dope is more aggressive. You know, so there's a different strategy, even though we both are talking about getting it, being in the market. But it's a fact that you build wealth by being in the stock market. It's not the only way to build wealth, but it is one of the ways to build wealth. And let me tell you, money in a savings account does not build wealth. You can't build wealth making 1%, 2%, 3%. It's safe, right? But you can maximize your money and buy. And look, this is the thing, you all. We're not just telling you to maximize your money just because you can maximize your money, because I know a lot of you, because I know you personally, you may be at retirement age or close to it or not. You still got goals. I know a bunch of y'all that still travel. And just think, if you had, and just for example's sake, $100,000 in a high yield account making $5,000, that's $5,000 a year that you could go towards your trip. So I know y'all still have goals. I know y'all just went dead and y'all not doing nothing, because a lot of y'all I know in retirement are enjoying it, and you need to enjoy your money that's working for you. So I hope y'all understand that, you know, we're being dope and not just pushing the stock market, but we're just pushing you to get the maximum out of your money. That's what the name of the game is, right? It's not how much money you make, it's what you do with what you make. That's always the game. So with that, we want to thank everybody once again for tuning in to the FITT Show. This is our 119th show. And full disclosure, we got a lot of this information from JP Morgan's Wealth Management site, which was so helpful, so much good information. And we like for y'all to share information that you have, because remember, we all are a family. We don't profess to know all the answers. We're looking for some of the information from you all too, especially like my good man Rodney Madison Sr., who's out there. He has another alternative investment called holding mortgage notes, like you being the bank instead of the bank being the bank. How about that one? But check that out at thenoteexperience.com. And there's so many things out there, y'all. So thank you as always. And just want to give a shout out to, you know, the roll call, Modestine. How you doing, Modestine? Dope. Modestine's always out there. First one, as soon as we click on the next, whose name I see pop up, Modestine. So we thank you so much for being, and look, and then Eva, and normally it's between Linda, my sister, and Modestine, and Modestine beat Linda by a minute this time. So thank you. Oh, wow, I'm looking at this. Then my sister Gloria came at a minute after Linda. So thank you all. And look, hey Nolia, I saw you just came on late, but you on. So I want to thank my wonderful, precious sisters for always supporting their baby brother. Thank you so much. Joanne Skinner. What's up, Joanne? Always glad to have you. And then the wonderful Now Dodie. Thank you for being on Now. And Now said good information. Thank you so much. And a woo woo to you, DS, Delta Sigma Theta girls out there. And that's it for this week. Tune in next week. And guess what? We're going to be at show 120. So have a good week, you all. May God bless you. We look forward and sharing information on the FITT Show. Financial information for today and tomorrow. Good night.